It's going to explode. I agree. Forget 3 times. I don't know how many times it's going to explode, because you've also got governments with their deficits, which will be ballooning because tax takes will go down, welfare payments go up. I mean, the whole thing is a catastrophe, which can only result in the collapse of the currencies. And indeed, I think what we're seeing with commodities, and particularly metals, is you're beginning to see governments and also the very, very big trading conglomerates getting out of dollars and getting into physical metal, the physical things they need.
In today's news recap, HSBC raises silver price outlook on gold strength. HSBC has lifted its silver price forecasts for 2025, 2026, and 2027, citing strong support from high gold prices and safe haven demand in the face of geopolitical and economic uncertainty. The bank now expects average silver prices of $35.14 per ounce in 2025, up from $30.28 previously, $33.96 in 2026, against an earlier forecast of $26.95. While silver prices have surged, HSBC cautioned that the rally is due more to silver's relationship with gold than underlying fundamentals, with record high gold exerting a strong gravitational pull on silver. Spot gold prices are up 29% so far this year, after hitting a record $3,500 per ounce in April, with the U.S. and China in the midst of a full-blown trade war, which triggered moves into safe haven assets. HSBC said that after 4 years of record high growth, industrial demand for silver may edge lower this year, although any declines are likely to be limited. It said demand would likely recover in 2026, driven by key sectors such as the photovoltaic industry and electronics. However, jewelry and silverware demand is likely to weaken further due to high prices, while coin and bar demand has been undercut by previous robust purchases and high prices, the bank added. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps, and go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
The answer, actually, there's only one answer, and that is the legal one. The legal one in everybody's common law. And that is that you have to tie the value of credit to what is called corporeal money. In other words, money which actually exists with no counterparty risk, and that's only gold. So we have to get back onto gold standards, in effect, working gold standards, so that the value of credit, because gold doesn't circulate. I mean, you don't end up paying things except as the last resort do you actually part with gold. It's always credit. Credit has to be tied to gold, and that's where we've got to get back to. They'll go down, they won't get there immediately. I mean, we won't. I think there's a very strong possibility that China is planning to go in that direction. But this is a defensive move as far as China is concerned, because she won't want her currency, which will be central to the new world, if you like, the new world away from us. She doesn't want her currency to collapse with the dollar or anything. I mean, she's quite happy to run a fiat currency system while the world is in a fiat currency system. But, when the dollar really does tank, I mean, she's going to protect herself. And, it's a sensible policy, because if she was to do it now, she would be accused of collapsing our system. She doesn't want that. So, it's sort of collapse is underway first, then China protects herself with the gold standard. And Russia, incidentally, Russia can do it tomorrow. Russia, I think, probably wanted to do it yesterday, but, the Chinese have persuaded them to stay the hand. So that's what's going to happen. The rest of the world is going to go onto a gold standard via the yuan in particular, and any other currency goes. And I mean, China's already planning to do this. She's opening Shanghai Gold Exchange vaults in Hong Kong and Saudi Arabia. Why Saudi Arabia? Because of oil. It's an oil to yuan to gold exchange standard in the making. Hong Kong is the financial center, if you like, the offshore financial center for China's capital activities. So, yeah, I mean, you got those. I think she'll probably open vaults elsewhere. I mean, you may recall that when on April the 2nd, or just after April the 2nd, when Trump had his, all these boards with all these rates that he was getting, tariff rates that he was proposing, President Xi the following week went round all the, well, not all of them, but most of the ASEAN nations in the district, talking to, to Thailand, to Vietnam, to Cambodia, to, Malaysia and Indonesia, I guess, as well. And now we don't know what he was saying, but I think quite simply, he was saying, look, we've got to band together on this. Now, of course, you band together on trade. ASEAN being a free trade area, they will bring in particularly Japan and Korea, South Korea. You can talk trade, but then you've got to talk about a settlement currency. And it's plainly not good enough, for example, to accept Indonesian currency, which, is going down and down and down and down. Why would you want to take settlement in that? You don't. So this is, it's clear to me which way this is going. And, we're sitting here with all our wonderful Keynesian ideas and gold as a pet rock and, in denial and all the rest of it. And how long are we going to take to turn that ship round? The ship of understanding. That's exactly what we've got to do. Because apart from that, you can't just go onto a gold standard. You've got to also change the government's outlook and its responsibilities and its relationship with the economy.
Massive news today as the Federal Reserve has issued a note relating to the re-evaluation of gold. Official reserve revaluations, the international experience with public debt at high levels. Some governments have begun to explore financing additional expenditures without raising taxes, while also not increasing public debt outstanding. One possibility is using proceeds from valuation gains on gold reserves, as has been floated in the U.S. and Belgium recently. For the U.S., this would involve revaluing the government's 261.5 million troy ounces in gold reserves, the largest gold reserves globally, from a statutory price of $42.22 per troy ounce to current market prices, which stand around $3,300 per troy ounce. This note reviews the rare cases when countries used proceeds from valuation gains on gold and foreign exchange reserves. Over the past 30 years, only 5 countries have done so: Germany, Italy, Lebanon, Curacao, and St. Martin and South Africa. Central banks have used revaluation proceeds to offset operating losses and maintain net profits or minimize reported net losses. In Italy, revaluation proceeds covered a one-off loss for the conversion of a specific bond the Banca d'Italia owned. The second broad category of revaluation transfer is when gold reserves are reported at fair value and funds listed in revaluation accounts are transferred to the central government. Now, we'll show you the best clips of the latest interviews, but first, smash the subscribe button and turn on notifications so you do not miss out on our recaps. And check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trading the gold-silver ratio and increase your ounces. With this easy-to-read book, you'll know everything you need to know to stack efficiently so you don't have to rely on market commentators. Enjoy the episode.
The politicians are not driven by common sense. They're driven, if you like, by what the electorate demands of them. And, when you see some people getting rich in gold and silver, it would be wrong to say that even the most sensible politician would not be tempted to do something about it. So, see, if they do it, I tell you, gold and silver will be bid only. which is market jargon for there will be none available. And if you want to get any on the black market, whoa, it's up, 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 up. And you probably won't get it anyway. So, the answer is that you've got to have your gold and silver long before that. But there is another aspect to this, which I haven't yet mentioned, and I think we should throw into the pot. And that is, with the end of this fiat currency era, we're also beginning to see the end of the derivative era, which has built up particularly since the 1980s. That I don't think anyone is really seriously looking at. But if you see now, I mean, we've had, particularly in metals and commodities generally, the demand for commodities and precious metals has really been from Asia, from the dynamic economies, rather than ours. We have been sellers. And what we have done is we've tried to suppress prices basically by increasing artificial supply in the form of derivatives. We now have a situation where, China in particular has benefited from this. We've suppressed the prices so that China has been able to buy these commodities cheaply. What she has done is she has accumulated inventory. I mean, she didn't tell us that she's accumulated huge quantities of silver, gold, platinum, palladium, copper, whatever. But she has. And in the past, she's been perfectly prepared to feed a bit of it into the market to try and stabilize prices. And this is particularly the case with silver. Now what's happening is she's no longer doing that. She sees the end of the fiat currency system, and she doesn't want to part with her stocks of metals, which she actually needs, whether it's to, form the basis of money in the case of gold, or whether it's for industrial purposes, particularly silver and copper and so on. I mean, she's hanging on to her stocks. So the liquidity, which the derivative markets depend on, the physical liquidity, is disappearing. It's gone. It's going. The more you look at it, the more difficult it is to deal with, because if you have your run-of-the-mill crisis like the Lehman crisis, which they call the Great Financial Crisis, this one is going to be even greater, I assure you. You can sort of see, okay, at that time, the Fed did exactly what we've been describing. They basically wrote an open check for the commercial banking system and the derivatives markets and said, here, you got a problem, we bail you out. Take as much money as you need. I mean, that's what the Fed did. But this time, this is a far, far greater mess. I mean, it is the end, if you like, of the fiat currency system. It's as simple as that. What will trigger it? Well, it can be anything. I mean, we've got a crisis developing in the relationship between physical metals, particularly precious metals, and derivatives. So that's one problem. Another problem is that bond yields are going to go a lot higher, and I think they will start going higher when people get back from their holidays and sort of start thinking, oh dear, we don't like the look of this. Foreigners own $40 trillion and underlying assets, dollar-denominated financial assets. Are they going to hang around there? I don't think so. And indeed, I think what we're seeing with commodities, and particularly metals, is you're beginning to see governments and also the very, very big trading conglomerates getting out of dollars and getting into physical metal, the physical things they need. I think they're beginning to move in that.
What do you think of Alasdair's take? Is he spot on? Will the BRICS nations' master plan come to fruition, or is all this nothing more than conspiracy theories? Post in the comment section down below your honest opinion and share with the stackers if you're accumulating more gold and silver on this run-up, or if on the other side you're taking profits. Thanks for watching. Now check this video right here because it's a perfect fit for you, and I'll see you on the other side.